Dr. Satyanarayana Chava, the founder and CEO, to talk about how their earnings performance was. Dr. Chava, great to have you today on ET Now. Your profit has more than doubled this quarter. Margins expanded 700 basis points. What was the reason behind the performance in this quarter?
There are a few reasons for very good performance in the Q1 FY27. The primary reason is our revenues from CDMO business grew significantly. The second, we also did very well in our affordable medicines, both APIs and our capacity utilization also increased. So there was the operational leverage. So these factors contributed three things. One is our gross margins went up from 59 to almost 63% compared to year on year. EBITDA went up significantly, almost 7 percentage points. We are now close to 32% EBITDA. And our PAT margin also went up because of these leverages.
And could you tell us, sir, what was the constant currency growth that you've seen this quarter?
When you compare our growth in constant currency terms, we grew 27%. Otherwise, it's 29% growth. When we do the constant currency growth, it is 2% less. That is 27% growth came from FY26 Q1 to FY27 Q1, 27% growth.
Right. Your ARV revenue growth has moderated a bit to about 3% this quarter. How is it that you're thinking about this segment as a growth driver going forward?
For the last several quarters, and in fact, even a few years, we are always informing our investors and stakeholders. Revenue from anti-retroviral segment will be 2,500 plus or minus 2. That later on we changed it to 2,600 plus or minus 200. We are still confident that this therapy will be anywhere between 26 to 2,800 crores in the next several years to come. It used to be primary revenue contributor for our company. The absolute value remained very stable, little growth. But percentage contribution wise is coming down because our other divisions are growing and our formulation in our affordable medicines are also growing. And we do expect this will remain in that range, 2,700 plus or minus 200.
And you've just in-licensed 2 ADC assets from Arvic Therapeutics. Can you give us a sense of the investment horizon before these become revenue accretive to you?
This quarter, our expenditure on R&D increased significantly, as we also mentioned in our investor presentation and also in the Capex call. Our investment into gene therapy, investment into ADCs, both Capex and OPEX went up. And we expect to our investment in R&D will be maybe closer to 5% level going forward. When it comes to our ADC licensing from Arvic Therapeutics, as we informed our investors earlier, we invested in Arvic Therapeutics to understand the ADC space very well. And to also understand the conjugation, purification, and fill finish, we thought better to license preclinical assets. So we were able to do process development, make material for GLP talks, which we expect will be done mid of next year. And those toxicities in vitro and then GLP talks are encouraging, then we will file an NDA. We don't expect any significant revenues coming from gene therapy and ADC programs in the coming 3-4 years. But I want to make one clarification here. Company already works on several programs of linkers and payloads in the ADC space, and we supply to a few big pharma clients in the ADC space.
Right. And your capex is currently at 19% of sales with a planned increase through FY27 and 28. Will it be funded via internal accruals or debt? And can you give us some more picture on the larger debt levels that you're currently sitting at, and what is exactly that you're targeting?
We increased our capex number from last 6-9 months to current. That was based on clear visibility on the programs, what we're doing with the customers with whom we are engaged, and technologies where we have to invest. This year, we expect to invest over 2,000 crores in capex, spanning small molecule APIs, drug product, and also in bio, and also in antibody drug conjugates. We will raise some additional debt, but most of the capex will be done through internal accruals. Even we raise a little bit of debt to fund our capex, our net debt by EBITDA will be very comfortable. We expect it will be below 1.25. So we are not going through significant leverage because of the capex what we are intended to invest.
And on the KRKA joint venture, sir, phase 1 production blocks are on track to open in mid-2027. What kind of revenue or order book visibility do you have for this facility? And can you give us some timeline on how long this will take in terms of the ramp-up period?
There are two manufacturing blocks we are building. The first one will be a small volume high-potent oncology block that will be ready for qualification January, February, March quarter, that is Q1 calendar year 2027. And the large volume normal solid oral plant will be ready for qualification mid of 2026. In the initial years, this joint venture is going to produce primarily for our partner Kappa in Europe. So we don't expect offering or using that facility for third-party customers in the near future. When it comes to capex, we already invested 400 crores, and we invest another 400 crores by the time the large volume OSD plant qualified. And some of these capex will also come from as a loan from our partner, majority through equity and partly through the loan. It's too early to give a projections, what is the revenue numbers, but we will give you more details in the near future.
And tell us a bit about your capex plans as well. What areas will be incremental capex, and where is it exactly that your focus is going to be?
The majority capex, what we intend to do will be around small volume APIs, mostly drug substances, and partly also drug product facility expansions. Some general capex also we will do. Our acquisition of 500 plus acres land is nearing completion. So we'll also start investing in general capex at that stage. That will happen, may not be in this financial year, maybe mostly happen in the next financial.
Looking 2 to 3 quarters out, margins are already at 31.8. Is this sustainable, you would say, in terms of the expectation that investors should have?
What we can say, and also we are confident, we will maintain 60+% gross margin and 30+% of EBITDA margins for the entire financial.
Right. On the new tariffs that Trump has announced, though, Dr. Chava, how is it that you see these generic tariffs impacting your business in the near to medium term, if at all?
See, currently, our foreign sales coming off generic supplies to US market is around 5% of our total revenues. And it is too early to comment how much that will be affected. We are not highly dependent on sales to FDFs into US market. So it's too early to comment.
And do you think that the tariff-free timeline of 2 years is enough for your company to adapt? Will there eventually be an exposure to tariffs that you will likely have to face? How do you play that?
I think we have to watch carefully and how things will emerge. And it is an ever-changing scenario. Will the time frame will be extended, or products are exempted, companies are exempted? It's too early to comment. But as I mentioned, our exposure to US market in overall sales is about 5% only.
Right, Dr. Chava, great to have you today on ET Now. Thank you so much for your time. Good speaking with you.